like this one. In this example, the trade entry was taken after the market closed back above the support level. The stop loss was placed below the liquidity sweep lows, and the target was set at the next key resistance level. Look at what happened next. The market moved exactly as expected and reached the target, delivering a clean swing trading opportunity with a very favorable risk-to-reward ratio. This is the euro versus the US dollar on the daily chart. As you can see, the market was clearly trending upward before reaching this area and reacting sharply lower, creating a strong resistance level where sellers previously took control. Now, once this resistance level was identified, the next step was simply to wait and observe how price would react if the market came back to this zone again. Look at what happened next. The market retraced back toward the resistance level, briefly broke above it, and then quickly closed back below the level, forming a clear doji candlestick pattern. This is a classic liquidity sweep. The breakout above resistance trapped breakout buyers and triggered the stop losses of sellers positioned above the level. But instead of continuing higher, the market rejected the breakout and closed back below resistance, signaling that smart money was likely taking control. And because this liquidity sweep happened with a single candle, it created a very tight stop-loss opportunity, which is one of the reasons why these setups can offer extremely high risk-to-reward ratios. Now the trade execution was very simple. The entry was taken after the candle closed back below the resistance level. The stop-loss was placed above the liquidity sweep high, and the target was set at the next key support level. Look at what happened next. As expected, the market moved lower and reached the target, creating a clean swing trading setup without needing to monitor the charts all day. Now look at this chart example. This is Nvidia on the daily chart. And as I said earlier, this strategy works across all financial markets, including Forex, stocks, cryptocurrencies, indices, and commodities. Now pay close attention to what happened here. The market moved downward and reacted strongly from this area multiple times. The first reaction created a clear support level. The second reaction confirmed that buyers were still defending the zone. And the third touch made this level even more important because the market kept respecting it. So once we identified this key support level, the next step was simply to wait for price to come back and reveal its intention. Now look at what happened next. The market retraced back toward the support level, briefly broke below it, and then quickly closed back above the level, forming a clear liquidity sweep. This move trapped sellers who entered after the breakout and also triggered the stop losses of buyers positioned below the support level. But instead of continuing lower, the market rejected the breakdown and pushed back upward, signaling strong buying pressure entering the market. Now the execution was very simple. The entry was taken after the market closed back above the support level. The stop loss was placed below the liquidity sweep low, and the target was set at the next key resistance level. Look at what happened next. The market rallied strongly, reached the target, and continued moving higher afterward, showing the power of trading liquidity sweeps on higher timeframes like the daily chart.